Savita, I guess there's 2 points to this question. One is, what should you do with transitory inflation, and how is the market and mutual funds and hedge funds prep for it?
Yeah, it's a really good question. So I think what you should do is think about transitory inflation as, a potential upward pressure on oil, on labor, on rents, and, kind of food prices, et cetera. But longer term, let's think about what we know kind of with some level of certainty. We know that the world is reopening. So we know that demand for driving, for flying, for services is likely to continue to accelerate as folks get out of their homes. And we don't think that's fully priced into the market yet. If you look at sectors like energy, like financials, like, areas of the services sector that would benefit from a reopening, those areas of the market are still trading at relative discounts to stay-at-home beneficiaries like technology, TMT. So I think that where we are is an environment where folks are sort of poo-pooing inflation as a transitory concern, but we could actually see a more sustained, expansion in some of these inflationary measures over the next several quarters. So I would stick with the cyclicals that benefit from inflation.
So, Savita, if you do want to play that future inflation thesis, do you have to time it, or do you just buy now, hold it, give it a couple of years?
Look, I think we're in for a longer-term upward trend in inflationary pressures. I mean, think about it. We've had supply taken offline for a lot of oil and energy companies, from activist investors, from, OPEC and curtailing supply. So I think oil is a theme that could have longer-term legs. The way I would invest in that is by looking for high-quality energy companies within the equity market that could benefit from upward pressure on oil, but are also paying out a stable and growing dividend. I think those are really interesting stocks, especially in an environment with tremendous interest rate volatility. I would stick with financials. I think that financials should benefit from what looks like a potential gradual incline in interest rates. They're a high-quality sector. They're still very inexpensive relative to the market. So those are areas that I would buy longer term. And then what I would watch more carefully is the services sector, the consumer services sector, because there I think what we're going to see is a big surge in pent-up demand and then maybe a little bit of a drop-off over time. So the sort of the long-term themes versus the short-term themes are different. I will tell you this, though, when you look at institutional investors, what I find interesting is that they are still massively underweight energy and still quite underweight financials. So it's not, I don't think the market and institutional investors are positioned. Yep.
Can I just jump in and take you back to that interest rate call? So we've seen, obviously, significant signs of the U.S. economy reopening. We've got evidence of the fact that inflation is coming through, 5% on the CPI number. Yet I still don't see a U.S. 10-year tracking significantly higher. There was talk a few weeks back, a couple of months back, and maybe we would track towards 2%. We haven't made it. We've gone in the opposite direction. Why do I want to do what you're suggesting if the bond market is not playing ball?
Well, here's the thing. I mean, let's think about the next few years. Are we going to continue to see massive stimulus from the Fed, from policymakers? Are we going to continue to see this liquidity route? Or I think what's different is that it's going to be really hard to lap the amount of liquidity that we've had injected into the capital markets over the last 12 months. So that's point number one. And then point number two is that I do think we'll start to hear the Fed talking about tapering, and then, talking about tapering. Eventually we're going to see some sort of upward pressure on interest rates. And then on top of that, I think as you start to see, on a global basis, liquidity trends, I mean, my argument would be we're at peak liquidity right now. Unless we're not at peak liquidity, I think interest rates have upward pressure over the next several years. On a daily basis, I think the forces are different. But I think if you think about a longer-term trend, my bet is up rather than down from here.